Do you know what your cap rate is on your rental property? Not what it's worth, but what it's actually earning relative to what it's worth. You see, most owners know two things about their rental properties. One, what they paid for it. The other, what it's roughly worth today, right? There is a third number that tells you whether their property is actually working for you. Most owners have never run it. Equity tells you the wealth you've built over time. That's real. And that matters. But what equity does not tell you is what your property is earning based on what it's worth today. We call that a cap rate, short for capitalization rate. Did you know that you can hold a significant equity in a property that is quietly underperforming in real terms? The equity is real. The performance may not match it. And if you're going to make any decision about a rental property, whether to hold it, to sell it, or keep it for another year, you need to know what it actually is producing, not what you think it's producing, what the numbers say. That the path is in the math. In the book Julie and I wrote, Property Decisions, we lay out what we call the plan framework. The P stands for properties. This is the first step in the property conversation, pulling 4 specific numbers for every rental that you own. Number 1, the current market value. Not what you think it is, what it would actually sell for in today's market. See, if you have not had a comparative market analysis in the last 12 months, you do not really have that number. Number 2, cost basis. What you paid plus improvements minus the depreciation the IRS has been applying to the property for years. That last part matters more than most owners realize. The IRS has been quietly reducing your cost basis through depreciation, and your taxable gain is larger than you think. Number 3, capital gains tax liability. This is the gap between your market value and your adjusted cost basis. In many markets like Hawaii, where values have doubled or even tripled over the last 2 decades, this number can be substantial. The owners who know it can plan around it. The owners who discover it at the closing table will be liable for capital gains tax. They may not even know it. They may find out the devastating truth on their property decision at the next tax season. Number 4, cap rate. The cap rate tells you how hard your property is working for you. The higher the cap rate, the more income it generates relative to its value. And this is a number most owners really never run. To find your cap rate, we use a simple formula. Start with your monthly gross rental income, then subtract your monthly operating expenses, not your mortgage now. Now your operating expenses are property management fees, maintenance, maybe repairs, insurance, property taxes, could be vacancy allowance. And the number that you're left with is called a monthly net operating income, NOI. When you times it by 12 to annualize that number, now take that annual NOI and divide it by the current market value of the property. That percentage is your cap rate. Here's a quick example. Having a property worth $800,000 with an annual gross rent of $48,000 and your annual operating expense of $18,000, that leaves you with an annual net operating income, NOI, of $30,000. You take that $30,000 divided by $800,000, that's a 3.75% cap rate. What does 3.75% mean? A well-performing residential rental property generally runs between 5 and 8%. Anything below 4% deserves a closer look, right? If your cap rate isn't even above 2%, the property is losing ground to inflation. You see, imagine your real estate as an asset similar to other assets like stocks or bonds. For other liquid assets that you own, you know the rate of return. So how come most people don't know the rate of return on their real estate? Well, it's because they don't do the math. They may not keep track of expenses, and they may not know the current market value of their asset. You have an asset that looks valuable on paper, and if it is producing less than what the money market account is, are you really stewarding wealth well? Could you be making more money in other assets? That is not a reason to panic, but it is a reason to stop assuming and start looking into your assets. Did you know that most rental owners have not actually calculated this number? They assume the property is performing because the value has gone up and the tenants are paying, right? The value and performance are 2 different things. The owners who make good decisions about their rentals are the ones who look at this clearly. not the ones who had the most equity. See, once you have these 4 numbers in front of you, you're in a position to make an actual good decision, not a guess, a decision. Right? From our experience for over the last 20 years and having successfully closed over 400 1031 exchanges, we've realized one thing, that there are generally 4 options for families. First, keeping it for a family member. If your plan is to keep it for a family member and you have only 1 child and your trust indicates that it goes to your child upon your demise, everything's fine, right? But if you have more than 1 child, please ensure that you've created a complete real estate plan that blesses all your kids equally so that you don't have a family dispute when you're gone. This is going to require a conversation that brings clarity to what your wishes are. Second, selling it and make more money, utilizing a 1031 exchange to defer all of your capital gains taxes. See, if your property is underperforming and you want to make more money, then 1031 exchange into a higher performing asset and keep all of your money. Third, selling it to bless a family member via a 1031 exchange. This is where we can help you create a pre-inheritance plan, a plan for your loved ones. If you want to prevent family disputes, you want to create a perception of fairness. This may take a real estate planner to structure a strategy that benefits all of your heirs. Fourth, selling it and invest it into a DST, a Delaware Statutory Trust, for passive income via a 1031 exchange. See, if you're an accredited investor, you have $1 million of net worth excluding your home, you may qualify for this option to build passive income. See, if you're done with management and don't want to pay capital gains tax anymore, you can do a 1031 exchange into a true passive investment in real estate called a DST. You could receive monthly income that you'll never have to deal with a tenant again, but we're going to cover all of this in a separate video in this series. The path you take will depend on your desire to make more money, bless your family, or create passive income. The decision is yours, but you cannot answer that without real numbers. Here's what I see most often. A family holds a rental property for 20 years and the value has grown significantly and they feel good about it. Then they decide to sell and they find out at the closing table that the capital gains tax exposure is far greater than expected. By this time, it's too late. The tax man is coming to get you and you're in a corner with no way out. This is very unfortunate. Far too many people are making property decisions without understanding the consequences and without understanding their options. The decisions that protect the wealth are only available when you understand your options before it's too late. Did you know that the difference between creating the real estate plan and having that conversation before a property decision is made can often save the family in excess of 6 digits? That's not a sales pitch. That exactly is what I've experienced over the last 20 years of serving families with more than 1 property. Planning matters, the conversation matters, your family matters. So run your numbers in about 3 minutes at propertyinvestmentcalculators.com or grab the full property performance worksheet from the free bonus kit at free.danihara.com, and it walks you through all 4 numbers all at once. Do that this weekend. And the numbers will tell you the conversation you're going to want to have next. Aloha.